Hey guys. Okay, I think we're live now. Let me I'm not sure that I've got the latency set correctly. Oh darn. Well, so you guys will be about 15 to 30 seconds behind me. Um Sorry, network limitations being what they are, that's just how it's set up. But we are live now and it's good to see all y'all. If you guys are just walking in, I would certainly appreciate it if you wouldn't mind giving a like on the stream on your way in and share on social media to get a few more people in here. That's what the YouTube algorithm likes to see. So if you guys want to help out and bring some friends in to chat with and discuss market conditions, that would be great. So we're looking at the S&P 500. We're currently in we're actually re-entering that ascending wedge that we were in for a while now. We re-entered back up to 410 on Tuesday when we had that really bullish pump from the CPI print, which was much cooler than expected. Now the market has effectively hit what I believe is a top. It's basically hit its head on this resistance 3 times now. So right here is where I see the biggest resistance for the market. And unless it can break above it and trade and trade consistently over 410, I don't see the market continuing to move up. There's a serious problem right now with market conditions, particularly that, well, everybody's getting really sick of how painful it's become. And I'm sure that I'm sure that there's going to be something said about that in Powell's speech today. But that's what we're mainly going to be covering. We're going to be paying attention to the FOMC minutes, which are due to be released at any moment, and the Fed Powell speech, which is going to be broadcast live at 11:30. So if you guys would like to help bring in a few others that we can go ahead and talk about this stuff and figure out what the market's going to do, feel free to share us on social media and get the crowd going. I'm actually going to let everybody know on Twitter that the stream is live. So if you'll excuse me for just a moment while I go do that. Okay. So our primary focus is going to be on SPY. And I'll just go ahead and give you guys the very simple strategy that I'm working with. If you do not trade options, then this doesn't apply to you. But essentially what Hell's Trading Floor, what many in Hell's Trading Floor are currently doing is most of us are playing a straddle. So a straddle, if you have never heard this term before, is a two-legged option strategy where you very simply you purchase a put and a call at the same strike price. The reason why you do that is because you are expecting the market to move, but you are unsure of which direction, or you believe that there will be giant swings to both sides. It was actually suggested to me, and this is it costs quite a bit of money to do something like this, but when you purchase a put and a call at the money for the SPY, with 0 or 1 day to expiration, you're basically betting that the SPY is going to move one way or the other. And what you're betting on is that it will move enough that it will create a profit no matter which direction it chooses. And these volatile moments are perfect for that kind of strategy. Hence why a straddle works for extremely volatile and unpredictable events. So one thing that you can do when choosing a straddle is you can either do a straddle or a strangle, and the difference is a straddle is at the money, both put and call, and a strangle is when you are going slightly out of the money with both the put and the call. And that's just for the purpose of reducing your cost, but also giving yourself a little bit of time. Okay, so we just got the minutes released. We're getting the volatility right now, and the candle is moving to the downside first, which is a little bit interesting, actually. Normally, we see the candle move to the downside move to the upside right away. So let's go see what the FOMC minutes release are. Going to the calendar for the statements, and here we go. Okay, there's the statement. I'm pulling it up right now. And while we watch the SPY, I'm going to go and analyze the minutes. All right, so I've put the SPY over here on. Oh wow, my oh, that's funny. Okay, so let me fix my chart a little bit. I'm gonna do this instead. Give me a moment to kind of fix my windows, but I will get this working for you. Okay. So, I've got the Federal Reserve minutes over here. Kind of stretch out my charts just a little bit more. Push it off to the side a little bit. And put Google in front, and there we go. All right, now we got it working. Cool. All right, so you guys can see the charts over on the side. I've got my minutes up so I can read this off, and we can go through the analysis. Recent indicators point to modest growth in spending and production. This is a typically bullish thing, but right now the Fed does not want to be seeing this. So this is hinting that the Fed is going to get more aggressive. That's the very first sentence right out of the gate on this statement. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances. Talking about Russia's war in Ukraine again. They're still harping on that. The committee has decided to raise the target range from the federal funds rate to 4.25% to 4.5%. So we're going for another 75 points hike. Let's see, the federal funds rate right now. Let me go pull it up.
We were at 4 already.
Yeah, I thought we were at a 3.75 federal funds effective rate. So is that only a 50 bips hike then?
Yeah, that's right.
Okay, so that is only a 50 bips hike. All right, so that meets expectations. That's really interesting. They're continuing to reduce holdings of Treasury securities and debt. Okay, so target's 50 points. That was within expectations. It's not unusually bearish. Or not unusually hawkish. It's the same amount of hawkishness as we had expected from the speech in November. Okay.
So the projection for the GDP looks better for this year.
Yeah.
Slightly worse for next year, and then pretty much the same.
So they're expecting spending and consumer cash to improve, productions to increase, inflation's remaining hot but slowly cooling off. I still don't feel like they got it under control. I think they're really vastly underestimating it, but whatever. Okay. But the way this is moving right now, I think that what we're going to see is we're likely going to see the market turn back around and we're going to see a new high back to 410. They're not being dovish, they're just kind of relaxing, not being as aggressive. The 50 bips decision is not that surprising. So this move to the downside is, in my view, institutional moves to try and get some liquidity to enter into long positions. And we'll see Powell step out onto the podium, and we're probably going to get a push to the upside. Yeah, this the move to the downside is is what surprises me. So that tells me that institutions are actually going to flip long. And this is just what they do. I've been paying really close attention to the moves that the market makes the right before Powell goes up to speak. And usually the first move is just wrong, or it feels wrong. And after analyzing the volume enough times, what I think is happening is we're just seeing an institution that's trying to hit stop losses, grab liquidity, and then push it to the opposite direction. I would love to get C-Dub in here, actually. It would be really nice to have him and his opinion. C-Dub analyzes literally everything that the Fed does constantly. He's always thinking about what the Fed's going to do. Did Bivy move? That's actually pretty cool. Well, that's it for the Fed notes. I don't see anything else in here that I need to really worry about or pay too much attention to. I'll go ahead and let me go put this back where it belongs and then make it disappear. There we go. And we'll go back to the SPY. We'll see what it does. But long term, I do think that the market is going to move to the downside, but I have a feeling institutions are going to push it one last time. The 50 bips hike is pretty much within expectations. But this volatility is really unpredictable and difficult to navigate. So if you're not in a position to play this kind of volatility, the best decision that you can make is just to not. Just don't play it. It's far better not to. What you can do instead is just wait for this stuff, this up down crazy whipsawing, to just pass and then enter into a position afterwards. There will be plenty of opportunities to switch into a swing trade over the long term now that the information is out there. If you're doing day trading, then this is great. You know, you can get into both positions for relatively small liquidity, grit, and then take a 100 or a 50% profit on either direction, and then just hold on to the other contract. If you're playing just purely stocks, I would probably say just don't. Just stay out of it and wait. Yeah, I see Pro XGT in the chat. I see he's not actually in the live stream, but if you are listening on the YouTube stream, homie, then one thing that I might suggest is just set yourself an exit for profit with your calls. If you have some calls, just give yourself like a give yourself a limit sell at like 20% profit or something like that, and just wait, because when Powell speaks, this thing's going to do crazy stuff. The volatility by itself will give you at least some opportunity to exit intact. So give yourself at least a limit sell and a chance to get out of the position. At these prices right now, I would think about grabbing some 0 DTE calls. I'm not going to, because I'm not jumping into that ridiculousness, but I'm trying to help navigate it. And the way that this is moving so far, I think that this is going to turn around in the opposite direction once Powell goes up onto the podium. at least for the short term. All right. Well, good luck, Pro. Moving up on no volume and small bids. Unfortunate thing that I have to tell you all is that I am not going to be able to be present for the actual speech that Powell is going to give. I have to be in a work meeting, so I'm going to have to be silent while Powell is speaking, and I'm going to try to pay attention to both while I'm on the phone at the same time, which is going to be awkward and frustrating, but I'll be coming back afterwards. It's literally like my boss scheduled it literally 10 minutes before I made the decision to stream. And I only had just gotten notified, and I was like, you've got to be kidding me. But it was his only available time slot. Believe me, I'm not happy about it. Hey, Winter, nice to see you. Hey, Alakazam. I'm sorry that I'm sorry to hear that, but I do hope that you'll be in better shape very soon, and you'll be able to join us again. We're working on some new things to help people stay consistent. First move always wrong. Gandhi probably. Hilariously misquoted statements. Okay. Yeah, if C-Dub is hanging out in the Bears Den, somebody should do me the favor of dragging him back up here so that we can talk around the spy. Okay. So let's go ahead and catch up on a couple of other things. Feel free to yes, don't worry. I'm gonna be on mute. No one has to hear me while I'm conducting a work meeting. Congratulations, James. Nice. So Tesla, I think that it may actually be setting up for a reversal. I've been waiting for a consistent sign of a bottom here for Tesla to turn around. I think we're getting very close because we're getting repeated bullish divergences on the RSI. The volume direction candles also look very good because we've been in a downtrend consistently on all time frames for the volume direction candles, and now we've gotten our first little, bear flag shape on the volume direction candles. What I'm looking for is for a breakout candle through this moving average. Because when you see that first breakout candle through the moving average, it usually is the signal for a trend reversal. And we're pretty far away from the slow moving average. So that means that it gives us a lot more room to run. You see, this last one didn't have a whole lot of room to go. It was like really tight. Okay. So it got that first pop and then it got rejected almost immediately. And this whole move only took like 2 days, right? But this one, if this breaks through here, then we could get a pop above the 20, and then we can see this thing go till like the 100 or the 200 moving average, somewhere in this range. And that's quite a decent amount of distance from peak to trough. You can get like 5 or 6% off of that one move. So that's an excellent setup. I've been really loving the volume direction candles because it really does help to illustrate. It visualizes the volume over time so much better. The trend of volume is so critically important and makes it so, so much easier to predict a bottom pattern since I've been using this. This is why I harped on the use of on balance volume as an indicator for a long time. But on balance volume isn't always as consistent. This indicator is great by comparison because it gives you moving averages to rely on where you can see trend movements. Like it actually compares price movement versus volume movement. And OBV is just purely adding and subtracting volume. This is actually considering the strength of the price move simultaneously with the amount of volume. And it's still taking into account the direction that the price and volume are taking it together. So it gives you the benefits of seeing when there's divergence, the same as OBV does, but it also lets you know exactly when there is a trend reversal happening or there is a breakout happening and you're getting continuation. It's been remarkably consistent and beneficial. Like right here, this crossover that happened on the 24th of October on Tesla, you could have played this. You could have captured this entire move and you could have gotten 11% just on that one breakout as soon as this cross happened. That's crazy. So I love this indicator. It's a really useful one. Hey, C-Dub, nice to see you. We were talking about the SPY, and we saw. I'm pretty sure I'm reading the minutes correctly, but it looked like we got that 50 bips hike, which was pretty much within expectation. I was curious about your thoughts, if you're willing to jump in and give your opinion.
Yeah, sure. Yeah, the 50 BPS was absolutely expected. I think anything other than that would have been shocking, and probably not good, even if it was 25. I'm not sure how the market would have reacted to that. I think they would have seen that as the Fed making a big mistake and easing too early. So there was no shock there. The initial reaction that we got, the algo reaction at 2 o'clock, was based on the summary of economic projections. The big thing there that changed was the Fed terminal rate. So in September, the Fed saw that terminal rate at 4.6 and they upped that to 5.1. And also increased the 2024 and 2025 rates only by 0.2, but still higher than they were. So it's not we're going to go higher and then come down. It's we're going to go higher and stay higher. So the market was not pricing that in, and that was the initial reaction we got. There was really nothing dovish that I saw in the initial statement. It was pretty much consensus across the board. The number of participants that agreed was pretty high, so that it wasn't one of those situations where you had some people that thought they should go down or should stay. It was pretty consistent that they all felt they needed to go up. So the market was expecting after the last two CPI releases coming in soft that they were going to, they expected the 50 basis points to stay, but really it's looking to see what are we going to get in February and are we going to get anything in March? So people on the dovish side were thinking we're going to get 50 now. Maybe that's it. Probably not. But I'd say the most dovish people might have said that, but the more realistic doves would have said 50 now, 25, and then hold. So this is more putting us in line for 50-50, 25 hold. So that's really what I see right now from that initial reaction. I have not taken a position based on that initial reaction, even though it looks back around for a little bit, has seen these reactions, where you get the big initial reaction a lot of times is in the wrong direction of the ultimate move. So, just from a technical standpoint, we broke the close, but held the low from yesterday. So that 390, 399, which was the gap fill too on the big gap up right from the CPI numbers. So hasn't done a whole lot right here. We're back below the 200-day, which is like 402.50-ish. And I think we're just going to, it's only 5 minutes now, 6 minutes. So it looks like we're just going to consolidate here and wait. And it just comes down to what Powell says. If he comes out and he's hawkish, the market's going to sell off. I would say good chance we close down around the 100-day somewhere, 393 area. If he comes out and, he's dovish and paints a glossy picture, we'll go right back up to high of the day. Maybe get back up, test, I don't know if we'll get all the way back up. I guess I could see us up in that 408 to 410 range. If he comes out and he's dovish. So it just depends on what he says and his tone. A lot of it is just his tone. If he comes out and downplays, the CPI and says, yeah, it doesn't really, it's not, we don't have all the data yet. And, I would say that's hawkish, right? So if he kind of downplays that, no evidence of inflation rolling over, et cetera, and just says basically what everybody thought we had, we don't have yet, so we're not changing. I don't want to say pivot because he's not going to pivot, but we're not taking our foot off the gas just yet.
Right.
If he comes out and says, hey, inflation's doing what we, is reacting the way we want it, takes like a little victory lap for himself, pats himself on the back a bit about, how they've managed this. Something that was, I don't want to take credit for this because I didn't, it's not my thought, but I think it's a good thought, so I'm going to repeat it. Was how he talks about the inflationary effects of the war in Ukraine. So they've made statements citing that as an inflationary reason in, I think, probably all of the statements that he's made. I don't know specifically, but it's been a consistent theme. So if he doesn't mention that, that's something to be on the lookout for. Like wheat and oil is back down at pre-war levels. So if he talks about commodities coming down, that's more dovish talk. So that's kind of the stuff I'm looking for.
Gotcha.
But
that's good.
I think yesterday's move was way overblown. I mean, you could see that by the sell-off, right? Like I was watching
it was
in the
way
morning.
too extreme.
I
was looking
we
at
printed 414 in the pre-market, which was crazy.
Yeah, when I saw that we opened at 410, I'm like, there's no way. Like with the way that we broke straight back into that ascending wedge and went all the way halfway through it, I was like, this thing's gonna go back right outside that wedge again. It got really, it got really close.
I didn't expect to get a full sell-off like that. The gap fill all the way back down to the 399 level. That was more. It kind of, it sold off down and it was consolidating around like just above the 200-day, so like 404, right. 405, and it looked like it was. I expected it to stay there, and then it broke down, and then it tried to consolidate, and then it broke down. But it did a good job kind of floating up on low volume. It tried to get back over that 200-day yesterday, got rejected pretty solidly around, what was that time, like 245. And then it worked its way back up there and did a good job just kind of floating up this morning, getting the 200-day. So we're back below that now, which is no surprise given the statement being more hawkish than I think anybody really expected. So we'll see what happens here. I'm going to jump off so I can listen to Powell.
Okay.
And,
I was actually going to say I'm going to stream the thing from Powell. But I actually have to be in a work meeting while he's speaking. So I'm not going to be able to offer any commentary while that's happening or immediately afterwards because I'll be playing catch up. But I'm going to leave Powell up on stream and just let everybody, listen in on what's going on, and I'll be back as soon as I can. If you have to drop, then I understand that's totally cool, dude. But if you,
so I'll come back, in a little bit when I can, once I'm kind of digested it and I'm in a position. I'll be happy to come back on and give some thoughts on what's going on.
All right, cool. So I'll see you then. Once we've listened in on everything that they've said, I'm gonna go ahead and put Powell's stream up here on the channel, and I'm gonna try to get back for everybody's benefit as quickly as I can. Hopefully this meeting that I'm going into will only last like 10 minutes. But yeah, so I've got the stream up. We'll go ahead and let this play. Turn the sound back on. they've got copyrighted music playing right now. I can't I can't just unmute it. God. Oh, here we go. Okay. All right. So I'll leave this for you guys and I'll be back soon. And y'all give me a shout if the sound is no good. I'll still be here watching and listening.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a 0.5 percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 0.75 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Temeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting. and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby?
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That's all. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see. We believe you need to see a better balancing of supply and demand in the labor market, so that you have. It's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael,
Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So, if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient, we think, sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but you know, it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually. It's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because, they gave us a job and we need to, do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal, and you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event, it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
Okay, guys, so that's the end of the Powell stream. The market pump is over. So what we're currently looking at for the market going forward. First, let me try to get this fixed. I want to maximize my screen space here. Okay, so okay. So, covering the results of the market, we've had a few conflicting statements, and after analyzing what Fed Chair Powell said, in my opinion, I saw no reason to be bullish on the market. He made very clear in his statements that the market is now, in his opinion, in a recession, and it's only a question of whether it is going to be a deep one or not. So I averaged down on my short position. I had an additional short available at 401.50 that has executed. I added in another sell limit at 404.50 just in case that we went a little bit further, but I think that we've hit a top. We got a evening star candle right here on a this is a classic reversal candle pattern on the 3-minute. So I think that that's going to be it for this market. We're now forming a tweezer candle on the 5-minute. So I don't think that's going to come back at this point. We may hit another top, so I'm going to leave that sell limit right here just in case. But I don't anticipate adding any more to this position. This is going to be a swing for me to the downside, playing the market down to around. I'm probably going to raise my take profit. I just kind of established this here for now. But after looking at how we have positioned ourselves, I like the chances for a return back to around 360 over the long term. Yeah, yeah, this is definitely not what we wanted to hear for a Santa rally. This completely blows a Santa rally away. So let's pick apart some of the things that Powell actually mentioned. Oh, is that? I thought I heard C-Dub come back.
Oh no, it was me.
Oh, hey Dave.
Just going to say that some people in the chat would seem to be very bullish for some reason, and yeah, I don't unless they can give us their side, their thinking.
Mm.
Yeah,
I'm
didn't hear anything
really.
bullish there at all.
If you're talking about the YouTube chat, I don't see the case. If you're talking about in trade floor, then I'm not looking at trade floor right now. But if somebody has a case or heard something that I didn't hear, then please,
The YouTube.
I'm keen to hear. But yeah, I'm not. I'm not worried about what was said in the YouTube chat about a 450 price target. That's entirely out of the realm of possibility. That's not happening. So after the speech by Powell, there's a few things in particular that I took note of that let me know that this is going to be a long road. So one thing for certain, he's confirmed that there's going to be no rate drops in 2023. So that confirms a restrictive policy for the next year. We're not going to see a drop in interest rates for at least another full year. They'll probably revisit it by about September next year, but in the near term, that any idea of a pivot is dead. It's gone. All right. People really do need to forget about the idea of a pivot. There's no pivot on the horizon right now. So the other thing was he specifically called it a recession, said the economy's in recession. It's just we're not certain if it's going to be a deep one or not. And in my opinion, this is going to be a tremendously deep recession. I think that they're entirely too optimistic or blowing smoke if they think that this will not be a deep recession. I think it's a question of, are we going into a deep recession or a depression at this point? So the market is responding really undecidedly right now, but I think that we will get a very clear decision after just a little bit longer. Another catalyst that we were looking at in yesterday, actually, was the possibility of a rail strike, which the strike is not happening, but protesting is ongoing in relation to the rail strike, and a lot of rail union and laborers are not happy with with Congress's decision to essentially just throw workers under the bus and tell them that they don't get their sick leave. There's not going to be any additional benefits afforded to them, and that they just have to suck it up. I feel that's tremendously wrong for several reasons, because those workers are the ones who kept our economy running throughout COVID, and especially doctors and nurses and truckers and train drivers and conductors. Like those people ran the economy and kept things going, even though it was done at great personal danger during the entire COVID pandemic. They kept the economy flourishing even in spite of all of that. And they had to do it through all the COVID restrictions that were in place that made life hell for them. And now that they want something in return, which really was just additional sick leave and a pay raise, the union is being told no by all of their employers. So, and now the Congress voted, and the president signed a bill that any strike that the rail unions organize at this point will be illegal. So that I have a huge problem with, because it sets a terribly dangerous precedent that says that essentially we are disregarding any further rights that workers would have. I'm really I'm really astounded by all the decisions that were made in the last couple of weeks between just basically telling laborers and everybody else who literally the heroes that saved the economy and kept it running during COVID is basically just go F yourself. You're not getting any additional benefits. Thanks very much. Move on and get the hell back to work. I have a huge problem with that. The attitude that Congress has is just total ingratitude. So anyway, yeah, I'm pissed. I'm super pissed. The whole situation is just really sad. And anyway, back to what Powell was saying. Restrictive policy is going to continue for the foreseeable future. I don't think that I really saw anything that was like deliberately dangerous to the market or anything like that. It's just that we now have confirmation that there's not going to be any additional policy. There's not going to be any additional policy relaxation taking place. I'm going to go ahead and adjust my limit sell order, and I'm going to go ahead and average down my position one more time. I think that we've gotten the confirm rejection now. So this rejection right here is, for me, confirmation. There's not a bounce coming. We've gotten our first sign of weakness, and we'll go ahead and go forward doing some analysis on this. I'm actually going to jump up to the 15-minute chart. Okay, got my fill. So now I'm in for a full risk position. I'm maxed out on my risk management strategy. So, I mean, I can go like another $40 risk, but I'm not going to do that. So this is my maximum risk. I'm not willing to put any more into my position than this. So this is about 1.5% of the risk tolerance for my portfolio. I'm already in for the max position. If I get stopped out here, then, well, I'd be completely shocked, because something would have to be something fundamentally would have to change in the market for this to turn around completely and put my entire position to stop me out of my position completely. I don't see the market returning back to 410. If it does, then something else happened that nobody could have predicted. Anyway, so near term, I see us returning down to 390 within the next couple of weeks. It could be as soon as end of day today, to be honest with you, though. We're heading deep into power hour. Things are going to probably get a little bit more volatile as we approach the close of the day. My expectation is for the market to chop around for a while. I'll be continuing to look for opportunities to average down on my positions in other stocks. But I'm basically going all short on the market, putting heavy emphasis on the risk-on sectors. Some growth sector stocks I will be looking forward to. I will be looking forward to some beneficial long positions, but those particular tickers that I am looking to go long in are almost exclusively going to be exposed to the retail sector for the Christmas sale season. So things like Walmart and Amazon potentially. I do have a long position in Amazon, but it's been weakening, so I think I'm actually going to close that right this second. That will give me a very small profit. I was entering this position in preparation for the Santa rally, but after that Fed speech, I'm really not keen on it anymore. So I'm going to go close my Amazon position. And that's locked me in for, let's see, closed for a $107 profit. It's not like super profitable, but after that Fed rate, after that Fed speech and the decision that they're absolutely not going to decrease interest rates going into next year, that tells me that the situation isn't as good as I was expecting. So I'm going to expect the market to get hit over the next couple of weeks and potentially jump back into a position in Amazon later on as we get closer to earnings season. I still think the earnings season will be beneficial, but I think that in the near term, the market's going to start really disliking the Fed notes and the implications it has for the market, and we're going to start seeing institutions bailing out of positions. I am going to take just a quick 5-minute break. I will be right back to continue the comments and take us into close. Okay, I am back. Thank you guys for your patience. So,
I was
let's go
just
ahead.
asking about.
What's up?
Okay. About to answer a question that someone had in the chat with MC, but go ahead. I can type. It's just my keyboard that keeps switching off for some reason.
Oh, no problem, Dave. Okay, so let me catch up with chat here. So, yeah, the 450 price target that was mentioned here was it was hilarious, but no, 450 is outside the realm of possibility, in my opinion. Any road to 360 on the SPY will probably take a while. I would expect to have to hold that position a minimum for a month for the SPY to return back down to those levels. And that's kind of what I'm estimating this swing is going to take. But I do believe that our Santa rally is pretty much done. I don't think that we're actually going to get that. So, after all of those comments from the Fed, though, and the I'm sorry, I'm getting an echo. Dave, would you mind muting? I keep getting an echo from something.
Oh, sorry, I didn't realize.
Thank you. No problem, dude. I forgot what I was saying. Oh, to 360. If you're selling stock short, then that's basically all you have to do is just give yourself a generous stop loss. 410, I think, is a pretty safe stop loss. That's where I've got my stop set at. The position is already beginning to move to the downside. We have a channel that's formed now. The ascending wedge that I had been drawing on the SPY has now basically broken down and formed a channel instead. And the breakout of that channel would be at approximately 395. If we break 395, then I think we'll very quickly see 390. But below that, we don't really have much support until you get down to 385. So from 395, there's kind of this gap in trading where you'll find it's very easy for the SPY to continue moving to the downside all the way to 385. That is a move that you can capture with some short-dated puts with about 2 to 4 weeks of trading time. To capture this full measured move all the way down to 360 or 350 would probably take the full quarter. But I do anticipate seeing the SPY move all the way back down to test these lows and possibly even go further lower after that. So this is an opportunity to get into a position early, give yourself a lot of time, because we do want to make sure that there's plenty of time for all of this news to settle into the market. And we are going to see some, we're going to see some bullish feedback coming back from some companies that will probably try to prop the market up, especially in the retail sector that's so exposed to the market during holiday sales season. And that's always a big bullish catalyst. Remember that December is on record, even during bear markets, is statistically the most bullish month of the year, or one of the most bullish months of the year. But that still leaves you with a lot of potential for downside, because right after that you have January, and a lot of crashes have gotten started in January. So you can already see that the short position that we've set up is very quickly moving in our favor. We already had our confirmed 2-top. The first top, if I go back to the 30-minute, we had a touch of 409.75. We actually had a high of 410, and then the gap up that we had yesterday brought us all the way up to a high of 410.50. And we even reached 414 in pre-market, which was nuts. But that's a confirmed 2-top. And now, since the Fed speech, we had this tweezer candle that appeared on the 15-minute, or was it it was the 5-minute that I saw the tweezer candle. But we've had several other bearish candles set up. We had this evening star that appeared here in the market, and that was pretty much the third top off of the double top. Usually what you see with a double top, I'll draw this over here for you guys. Usually what you see with the double top is you'll see the market moving up like this. It'll come back down. It'll touch the same level again, and then it'll try to go up, but it fails about halfway, and then it starts coming down. So when I say a 2-top touch, this is the 2-top that the SPY just did, and then this move right here matches the third little leg on a classic double top formation, and that's when you get that attempt to recapture these highs that fails. So that's always the area that you go short on. If you're just trading off of like a classic by the book double top pattern, you wait for the reattempt to recapture highs that fails, and then you short it immediately on that failure. If you were here earlier when C-Dub was hanging out with us on the stream, that's what he was referring to when he was saying to look for the bounce. There was actually another double top at this area. You had this double top right here, and he said, "I'm looking for the bounce." This was it. This was the bounce. You had a top, and then a retest and failure to recapture this range. That is the failure that he was likely looking for. He says he'll be coming back at some point later on, so he can give us his comments on what he thinks the SPY is going to do. But he's been chatting in the live stream chat, and I'm pretty sure he's just as bearish as I am right now. So my thoughts are, in terms of the next month, I think that we're definitely going to see 380 again in our future. 360 and a retest of the previous 52-week low for the SPY is where I see us going back to over the quarter, at least. There we go. Okay, so C-Dub just sent me an update in chat saying he ended up adding on the rejection of VWAP, which is this move that you all see right here. I'll put VWAP on my chart really quickly. This is the rejection of VWAP, so he saw the exact same thing that I did, this evening star candlestick pattern. That's this candle right here. You had a big green dynamite candle. You have this evening star, and then the rejection candle. That is that rejection of VWAP that he was talking about. See this blue line right here. This blue line is our VWAP, and then these are the ATR bands that are on the outer sides of the VWAP. As soon as he saw this red candle, that's the rejection he was looking for. So he probably entered on this candle, or he may have gotten it right off of the, I'm not sure if he's using moving averages, but that was a good play. That's exactly where I added to. I have my position set up at 401.50. So basically, I was playing VWAP, and I had my buy. I had my short position to add at this level. I had another one at 405 just in case we didn't quite reach it. I think maybe I was being a little bit too greedy to add a position all the way up here, but 403 definitely would have executed. So that rejection, very, very good rejection. Now what we're seeing is we've got this downslope. So on the 3-minute, we have a bear flag beginning to form. So if you guys are fans of day trading, this setup right here, let me change the colors, make this a little bit easier to see. This appears to be forming what I believe is going to look like a bear flag by the time it's done playing out. So once the market is done making its decision, we'll get this chop finished playing out, and then eventually we'll get a breakout to the downside to look for, and then continuation to the downside. So that is an opportunity to average down. I'm actually going to look elsewhere because I'm already fully entered into all of my positions that I'm willing to for the SPY. It's time for me to go looking for another trade. But that is my opinion and my position on the SPY. Let's go ahead and catch up with some other areas of the market. If you guys want to drop something in the chat, leave me your tickers and anything else that you're currently looking at. If you want me to do some TA for you, I'm happy to do it. I'm also going to be just talking about a few other things like trading mindset. There's been this topic of I've seen a lot of serious negativity happening on social media that really spoke to me, and I've seen how people's trading mindset has become truly polluted. So I wanted to talk a little bit about that while I was on stream today. But I'll catch up with chat really quickly, and then we'll move forward. So Pablo J's asking, what are your thoughts on Excella at this point? Would it be one you would consider DCA down on for a long play, subject to them not getting delisted? TradingView 1 year analyst price target is $2. So for me, Excella. So Excella on its face looks like a good company, but at this point, I feel like the executives are just lying to everybody. So I've already taken my lumps with Excella. I'm not adding anything to it, and I'm not going to suggest anybody else do that either. For me, Excella was a huge. This was a huge blow. I saw legitimate reasons fundamentally that the company was in better shape, but I'm beginning to feel like those numbers were even if they were accurate, were just fluff to entice investors, and I was one such investor. And plenty of people did warn me about the executive Parchata, that he was just using people to sell and dilute stock, that he was just trying to use me, and I definitely feel like I got used. So it's one of those situations where I fell for a sales pitch. I looked at the numbers. I saw many reasons to be bullish on this company because of what they were creating and the fact that they already had such a huge revenue stream, and that they were very communicative with their investor base. But after a while of seeing, like, every time something good happened, more and more stock would just get sold into the market, and more shares getting dumped on investors. And I'm just like, at this point, I just have to admit that I was just flat out wrong about Excella. Not because there's anything fundamentally wrong with the company, but because there is something fundamentally wrong with the behavior of the executive team. Parchata, as far as I am concerned, is scum of the earth and an absolute just waste of oxygen as a human being. And he lied to me. He lied to everybody that was sitting alongside me, reading all of the information. And I definitely feel like I got duped. And I'll take this time to apologize to everybody, because I do know the responsibility I have to try and do my due diligence to the best of my ability. Try to make as accurate calls as I can. And I do take it personally when I can't be right. It does affect me. And ever since Excella, more and more accusations come out that I'm just a pump and dumper. And it's totally wrong. And I'll never be able to convince everybody of that. But just telling you from where I'm sitting that I don't do that. I'm not a pump and dumper. I take it really personally when people tell me that, because it's not what I do. I try my best to look objectively at the data that's in front of me. I work very hard at analyzing stocks for their potential. I look for growth opportunities. I look at the technology, and it's a space that I'm very comfortable in. I understand technology very well. I understand computers very well. I'm a consultant, for God's sake. Like, that's my job. That's my day job, is to teach people how to leverage the technology of their companies, make it secure, and make it functional. That's what I do. I'm not a stockbroker by trade. I'm a consultant. I teach people how to make the most out of their technology and how to secure it. But I do understand it very well, is my point. And I saw the potential with Excella and the technology they had and the customers that they were getting. And I saw it was very good. And it's very clear to me that they are making money. But it's also now very clear to me at this point that Excella as a company and its executives are only interested in stealing from their shareholders. That is my opinion at this point. I have yielded to the facts that Excella's executive team are just snakes, and they are stealing from people. And I haven't suggested to anybody that they buy this stock for many months, but at this point, I don't also want to be the reason why people sell and give up on something that they have conviction in. But at this point, I've given up on this one. And I'm sorry for everybody that got hurt that followed me.
Is it all right if I say something?
Go ahead, Dave. Yeah, you can say something.
Sorry, I wasn't sure how to when you were stopping. Yeah, I think we've just recently realised quite how we knew the levels of corruption and fraud were pretty bad in the market already, but I think recent events have gone to show that it's like 100 times worse than we even, we've just been touching the tip of the iceberg.
Yeah, it does.
Pe-
It's
people
become
we-
pretty clear to me that we only just really scratched the surface of the levels of corruption that we uncovered so far. And I now understand just how endemic it is to the functioning of our financial system, because in my time since doing this, I've had time to read SEC filings. I've had time to read past SEC complaints and cases and lawsuits and all sorts of things, going all the way back to 1994. And I now understand that it is built into the system and it's structured this way with intention. And now the reaction from the reaction from the SEC to go after Zach Morris, and I do think that he should be sued and probably arrested and put in prison, because he was a pump and dumper. That was exactly what he did, and he wasn't shy about it. Like, it's not even something that I have to work very hard to prove. He was very clear in his intentions and just how brazen he was, and I can't believe that somebody could be that bold and that stupid, but he was. So, that was how he made his money, was using his followers for exit liquidity. But the issue that I have is that, why is it that he is the first one that the SEC is going after when we have documented proof of other much more sinister and serious thievery going on in the financial markets? Like, somebody, I saw this post on Twitter. I can't remember who it was that shared it, but it was somebody in the ape community that specifically was saying, like, Zach Morris is just, he's just a symptom of the problem, and that, like, why isn't the guy who went on to CNBC to pump up Upstart back in 2021, why isn't he being arrested? Why isn't he swimming in SEC complaints and lawsuits? Because he walked on to that, in front of that camera, and pumped up UPST, talking about how great of a company it was, how amazing their financials were, and how their technology and their future was so bright. And then when he was asked, like, what do they do? And he just didn't answer. He just couldn't answer. He got asked point blank, like, what does the company do? Like, we don't actually remember what they do. And the answer is they're a loan company. They're a startup loan servicer. But he didn't know that, and he made excuses like a freaking child, like a toddler caught in a lie. Like, did you take that cookie? And he's like, no, what cookie? He was on camera saying, like, oh, you're breaking up. Like, literally, like, he just pretended like he couldn't hear the anchor and just fiddled with his earpiece and then, like, disconnected from the call. And it was so obvious, for one, but it was also just such a joke. And that guy's fine. Like, he's making all kinds of money. Yeah, Jim Cramer is another one. Like, he pumps up stocks all the time. And he'll talk about, like, and, he can be wrong. Most people are going to be wrong most of the time in the market. It's just the way of it. But he'll pump things up moments, like the day or just a couple days before it plummets. And he's such a hypester about it. Why isn't Jim Cramer swimming in SEC complaints? Is it because he's not personally investing in it himself and he's just the mouthpiece for another hedge fund? How messed up is that? Like, that's the problem that I have with it. And that's why I take it so personally when people accuse me of being a pumper, because I'm not. By definition, a person who pumps up stocks is providing materially false information. And I'm not. I'm just reporting the financials and I'm giving my opinion. And that's all I'm trying to do is just provide an opinion. I'm trying to provide what little experience I have in the market to try and give context to what the numbers mean and do my best to interpret the confusing and absurd language and all of the games that these people play in front of the camera. Like, even just watching Fed Powell speak on that podium, what he is doing is manipulating the market, and it's legal. It's legal manipulation. He's doing what he can in his position to manipulate the market to behave and act and respond to his words in a very specific way in order to drive federal monetary policy. And it's just a requirement of a central bank because that's what their job is, but it's still market manipulation. We have to be very clear about what is and what isn't market manipulation. Zach Morris was a market manipulator. He used a following of 500,000 people to reach hundreds of thousands within a matter of seconds in order to pump up stocks, get people to buy into it, and sell into the pump, and use them for exit liquidity in order to sell millions of dollars worth of stocks as it was driving. And I'm not doing that. When I lose on a position, when everybody loses on a position, when I call out something, I lose too. I go into these positions with everybody. And I'm not like even, I don't have the kind of money where exit liquidity is even a problem. I bet a few hundred or maybe $1,000 on stocks at a time. I'm not spending millions of dollars like people think I am. I don't have that kind of money. I wish I had that kind of money, you know? But anyway, I appreciate you, Pablo, for the question about Excella and bringing up the topic, because it's something that I've been meaning to talk about anyway. Been on my mind. I see the notes, Jay Brown. Thanks for the call out. We're 4 minutes from close. And I do appreciate the support that I do get from the community. I am not too proud to admit that sometimes the things that people say about me do get to me. It does eventually get under your skin. I don't think it's possible to completely insulate yourself from this kind of stuff. It's pretty brutal and vicious, the things that people will say about you when money gets involved. Okay, so SPY is getting rejected by its 50-period EMA on the 3-minute. That confirmation candle right there, not quite a 3-line strike. We're missing a third green candle here, but we did get this engulfing candle on a tweezer pattern. So now we have had a high, a lower high, and a lower high. So this, and now we've also got a head and shoulders that's formed. So I'm pretty confident that we're about to gap down tomorrow. I've got a stop loss that is healthily far away from my risk. I'm not even worried. We're only just getting into this position, so this is going to be an overnight swing. Probably going to be staying in this position for the next month. If you're playing this for the week, I think that you could probably. I think that at this point, the volatility will more or less be over. I would stick to longer dated put options for the SPY and try to stay close to the money and look for opportunities to average down if the market gets like a little bit, pumpy. If it starts jumping up a little bit, take those. You can take those opportunities to average down, get little averages down on your positions. If you're not able to play with SPY, you can consider SPXU. This is an inverse ETF, so be sure you understand this. But this is a nice low budget way to play the SPY to the downside. So if you're trading with a cash account, you don't have access to margin, you can't short, and you and you can't buy puts on SPY because it's too expensive, you can buy calls in SPXU. So there's only about 30 seconds in the market now, but SPXU calls are a great way to go short on the market. Whenever the SPY goes down, SPXU goes up. So it's a 3 times leveraged ticker that bets against the SPY. So whatever SPY does, this will do 3 times the opposite relative to price change. So if SPY goes down 1%, SPXU goes up 3%. So that's how you can use this to think about that. Calls on SPXU are how I played the entire downside since the top that happened back in August. And we made crazy good money on that. So there will be opportunities later this week to enter. So if you're not getting in now, and by the way, ding, 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 that is the bell. If you didn't get a chance to get into a position after that, don't worry about it. There's going to be other opportunities. There's always going to be opportunities in the market. That's one thing that I really, really want to emphasize for everybody is that this market always provides ample opportunity for people to make money. There's ways to do it in both directions. So don't ever rush a trade. Don't overtrade. Only trade the good setups in your favor that work for you. And one thing that I would highly encourage people to do is to not listen to me. Don't listen to me expecting me to tell you what and how to trade. You should only listen to me to get ideas and to get information, but it really is up to each individual to start, figuring out their own strategy and learning how to make the market work for them. What works for me may not work for you. I'm a swing trader. I do things differently. And my risk tolerance is different than others. Some people are playing with thousands and some people are playing with hundreds and some people are playing with singles, So what works for one trader doesn't work for everybody. I appreciate the support, guys. I do appreciate it. It does mean a lot. Train Gabriel, thanks. And cheers. I have a couple of friends in the Discord that are from Romania. And I really am very happy that you're learning so much. Hey Donnie, I wish you luck with your bet on the SPY. I humbly disagree with you. I don't think 410 is in the cards, but good luck to you anyway. I wish you the best. I would just say be careful and make sure that you are listening to both cases, bullish and bearish. Thanks, Persephone. Yeah. I'm shocked with the amount of people that are playing puts and calls that don't actually understand how they work. It's not too surprising because by themselves options are pretty confusing and complicated, but I'm very scared for people that are playing them without understanding how they work. Finally, so this will probably make people laugh. For those of you that were here when I had to drop from my meeting, my boss, who demanded that I had to be there at precisely the time that Powell was going up on the podium, that pissed me off so badly. My boss didn't even show. He didn't even show up. I was left there by myself with the other people on the call, asking where is the boss? Where is he at? And I'm like, I don't know. And I was the one that everybody was looking at to know where he was, and he wasn't responding to my messages. So not only did I miss the first half of what Powell had to say, and I had to go back and listen in order to catch up with everything, I also had to I had to sit on a call with 3 other people looking like a total asshat because I had no idea where my boss was that made us sit in on this thing, or what. To honestly tell you, I didn't even know what the call was about. So talk about awkward. Maybe he was watching Powell. Maybe I should have said something like, yo, don't you know the Fed's meeting is happening right then? Like, let's just push it off an hour, you know? That would have been too funny. All right, let's go ahead and take a look at some of the other stuff. So we got a lot of other things that we can look at to give ourselves some insight. Oh, you know what? Let's see. I want to go and look at my meta position again really quickly. I can't exit it today, but I'm looking at meta and yeah, this looks like it's gotten weaker, much, much weaker. I'm going to exit meta tomorrow. TradingView won't let me exit after hours. I wish it would. Like, it's dumb that it doesn't. Like, it's just paper position. Like, why can't you exit real time? Yeah, see, rejected off trading session. I think that's stupid. I wonder if there's a setting to fix that. I'll have to check and see, but yeah, you can't place and execute orders in after hours. It's really dumb. It's very, very dumb. But anyway, it doesn't really matter. What I'm gonna do is I'm just gonna move my stop loss up here wherever we're at. And I'm gonna take profit on meta. So whatever I can't even modify the order. Man, TradingView, you're dumb. I'm gonna send a complaint to TradingView to complain about that because like that's stupid. If somebody's doing paper trading, then you should at least be able to paper trade in after hours. That's really stupid that they don't offer that. I saw somebody requesting for FFIE, so we're gonna go take a look at that next. So FFIE was looking a little bit weak. A lot of Hell's Trading Floor took profit on this move that happened up here. Once we broke VWAP and moved back to the downside, this was pretty much our exit to downside risk, and we got out of positions. Quite a bit of us. I don't know if everybody was able to make an exit here, but we did see we did not expect this move. This was really surprising. So we took profit on. I'd say most people took profit on at least half their positions, and others left a few runners. This consolidation looked very nice up until we broke the 50 EMA on the 5-minute, and we moved back down today. So we're seeing a little bit more strength coming back into it, but we need to see continuation. So moving over to the 1-hour chart. Right now, FFIE is consolidating. It's got a nice setup so far, but one thing to be careful of is that we have now formed a head and shoulders. So if we do end up retesting the 45 level, 45 cents, this is somewhere to look for a downside weakness. So far, we haven't had a touch outside of the price cloud yet. We got really close on the MACD 1-hour chart. So what I would be doing is if you are in a position already and you're in profit, is to consider having a exit that is in profit down here, so that if there is a move to the downside, you get that exit and you keep some of those profits and then wait for this consolidation to end. Because what's going on with FFIE right now is it's still currently at a bit of risk for a reverse split. They do have a approved reverse split. I've said this many times, so I want to make sure I keep reiterating it. So if you've heard this before, I'm just telling it telling everybody who's new to this and hasn't gotten to the play yet. FFIE does have an outstanding shelf offering, and they have the ability to execute a reverse split at any time. So be really, really sure that you're willing to take that risk, because right now they're below the NASDAQ listing requirements. They have plenty of time before they are at risk of delisting, but they do need to get back above $1, and a reverse split is usually the easiest way for them to do that. So be very, very aware of that going into this play if you add to it. I got some stuff happening at work that I'm going to have to get to after this is over. I will, but I'm in good shape for right now. I'll get back to that in a short while. Sorry, guys. I'm juggling everything. Big Orange Machine. Nice to see you again, dude. Can I trade on extended hours? Trading during extended hours is not supported on paper trading at the moment. Oh, okay. You're just letting me know the trading view policy. Okay. Well, thanks for the heads up, but not a big deal. I'm not really that stressed about it. After all, this is a paper trading account. I'm just trying to provide people with the information whenever I'm trading any of this stuff. We went bullish on Meta back. We went bullish on Meta back on. I think we went bullish back on Monday. Kind of want to say it was last week, but well, anyway, it doesn't matter. We're taking profit tomorrow, so we'll see. We'll see what the market does in the morning. I'll look for an exit then, because I need to clear some of these positions off. I've got a lot of outstanding losses because of BBIG. I marked a position in BBIG and didn't set a stop loss because I just wanted to see what would happen. This is responsible for this is probably responsible for 80% of my total drawdown on this trading account, just because of this right now. So I'm still I'm pretty annoyed by the whole thing. I'll be honest with you, but I'm not personally sweating it. I still do have I still have utmost conviction that BBIG is a good company, but I am very, very annoyed with the inaction by the executives. It's still ongoing. It's still a problem. And we'll talk about that on another video at some point in the future. But for right now, I'll just go ahead and go cover the current position on BBIG. So right now, we do have a few bullish signals. For one, we have a confirmed double bottom, which is really nice. If you look at the 1 hour chart, you can actually look at this on a daily as well. You can see that we have a very clear double bottom pattern right here. So we have 2 candle touches at the 51 cent level. The wicks touched these areas, and we had, in this area, we had the double bottom range that you're looking for is for the candle that goes into this range. You expect it to enter and close inside of this range or above it. If any candles close below this, then the double bottom is broken and you expect continuation to the downside. But for the daily chart, things are looking really good. The situation right now is we've had our second touch outside of the price cloud in very short order. It's been about a month, little over a month, since we've had this low in the market. And now we've had this double bottom pattern that formed. See, this is exactly what I'm talking about, where you have a double bottom that breaks. See this red candle right here on the 22nd of November, since this closed below, that breaks the double bottom pattern and we get continuation to the downside. So that is no bueno. But this time we have our first candle that has entered and closed inside of this range. What we're looking for now is a reversal candle to exit this area and close above. We want to see a nice big green candle to return back to the upside and hopefully close, hopefully engulf the previous red candle. That would be ideal. But at the very least, we want to see a nice, good, strong bounce and to see bullish divergence in the charts. So we've already gotten We've already gotten some divergence in the RSI. It's not bullish divergence because this did not create a lower low. It was actually a higher low. So it was a difference of maybe like 0.5% or 0.25%, like 20, 25 basis points. But what we're seeing is that the volume direction candles are starting to hang out above its fast moving average, and we're moving a little bit closer towards the slow moving average on the 1 hour chart. And you can see that the last time that we did that, that was right in this area, we started to consolidate above, and we had one last big push down right before the market popped. And we had this big move that happened in a very short period of time. We also had a very similar situation occur back here, where we had a push back above the fast moving average right before BBIG took off to the upside. And that happened right after BBIG unhalted. I suspect that if BBIG had never halted, that we would have seen more consolidation above, and this wouldn't have been such an extreme sudden move. But I do think that we would have likely seen a big pop in the stock and then a return back to normalcy. But that kind of movement, this kind of move, is exactly what we're looking to capture on BBIG. So for now, the only thing to really do is to look for signs of reversal and continue accumulating. So as far as other technicals to take note of, we had this tweezer bottom here on December the 7th, and here we've had this a morning star candle. We're waiting on a confirmation candle to break back to the upside. So right now we're so far getting rejection. So this red candle indicates rejection. So we're still undecided. It looks as though the market is potentially moving to reverse for BBIG, but it's not confirmed yet. So we have to wait and see. One thing that I did take note of is that BBIG's dark pool volume has gotten really, really out of hand. For a brief period of time, specifically this day, BBIG's dark pool volume dropped below 35% for the first time. For the first time in months. And the price went crazy because all of the volume that was traded in the stock was being directed to the lit exchange, and we got real price discovery. And you can verify this by going to chartexchange.com and seeing for yourself. But you could go to the exchange volume history, and you'll see that on this particular day, the 7th and the 8th of December, there was very low dark pool volume. And then as soon as the dark pool volume went back above 70%, price went back into decline again, and we started getting bearishness almost immediately. It's really fascinating to watch. And that, just so that you're aware, most of that dark pool volume is going through an internalizer for the market maker. So that's what the alternative trading system is, where all of this is coming from. What do I think about the new CEO situation? James, which CEO are you referring to? Are you talking about BBIG? If so, I haven't heard about it, so I'm still kind of playing catch up. I've been really trying to keep up between work and all the research that's going on. Yeah, the Mullen news I did hear about. Yeah, I saw that Mullen was getting a new partnership with a dealer. So they're getting ready to move their cars to production and sales. So that's good news for them. I'm still really not a fan of Mullen. I'm not sold on their executive team. I still feel really sketched out by them. But all the same, I don't wish anybody any ill will. Clearly, Mullen's performance is excellent today. It moved an outstanding amount this week. Even over the whole week altogether. It's up 36% on the week, so that's great. Like I don't feel jaded or anything like that. I'm happy if everybody is winning. Oh, today was the charging company. That's right. Sorry about that. I got my news media mixed up. But yeah, Mullen got a partnership. I think it was yesterday. They got the partnership with the dealer. Now they have a partnership for the charging stations. So both of those are very cool, very positive bits of news. So I do like that. That's definitely good for the company. I feel a certain kind of way about the executives, and I'm really sketched out by the company. I don't fault anybody for wanting to invest in them though, because I understand it's a high conviction play, and I also understand that I was one of the first people to call it out because of the short exempt volume. But for me, it was purely for that reason alone that the company was literally under attack, and I saw an opportunity to hit market makers that were over leveraging themselves, and that was my sole reason for jumping in on that. But that being said, I'm looking at let's see what other plays am I looking at? Tilray's kind of sold off. Excuse me, I got the hiccups. Tilray's kind of sold off from this high, but it's been moving in this broadening wedge to the upside. This is a nice bullish wedge. You could call it a bullish megaphone, actually. So this one could take another move to the upside. I'm actually going to set myself up for a long position here so that I remember. I don't want to forget about this. And I'm going to set my low, my stop right here at the previous low on the touch that happened out here. And if I do get the bounce tomorrow, then I'll move my stop loss up to this previous low. But this is a really nice setup. So I'm just kind of staging this for right now. If I add into this position, or if I make this position change, I'll let everybody in Hell's trading floor know. So Tilray I wanted to jump into just because of the weed legislation. This is one in particular is really this is a popular company that everybody is really familiar with. Sentiment's good. They've made a lot of really good acquisitions, I feel, between growers and distributors, and I think they have a decent chance of getting approved for selling, distributing, and opening dispensaries in the United States, especially in the state of New York. SNDL, that's Sundial, is another weed stock that's particularly memey. Everybody's really everyone's really happy with that stock also, but it's really been getting brutalized for a long time, and they had a reverse split not too long ago, so there's some conflicting feelings about it. But looking at where it is on its chart, I do see it's formed an inverse head and shoulders, so it could be that we get a bounce here and a breakout above $3. That would be really cool. But for me, Sundial doesn't have as much brand recognition, and it hasn't been trading on the market for nearly as long as Tilray has. But one thing that I will say about Sundial is that their volume direction candles look really, 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 really good. This moving average here has been consolidating for a while. And now it's finally getting to that plateau phase, the very end of the plateau phase, that makes me think that it's getting ready to make a move. So I will keep an eye on Sundial. It just doesn't have quite the brand recognition or the financial support that Tilray has that makes me gravitate more towards Tilray brand. I was also taking a look at Party City Holdings. This one is facing bankruptcy, but I was asked to keep an eye on it, so I'm just kind of checking in right now. Hey, Grilled Rockfish. Yeah, I'll take a look at T. Is that AT&T? I think that's AT&T. I'll take a look at it. Party City Holdings. We do have that. We did finally get that cross on the MACD. Now I would be waiting for a bullish divergence on the RSI on the 1 hour chart or the daily. But we don't have a bounce in sight yet, so we have to wait it out. So I'm still keeping an eye on it. I'm checking it every day. I will update people on any fundamental changes in the company. But for right now, it's still in selling territory, and we've gotten this cross down in the volume direction candles, so it's not looking great. I don't think that it's one. I don't think it's a buy yet. And it is like it's kind of like a little known party store. So just saying, like, this one may never become a play. I'm not going to short it because it's not worth it to short. It's too small of a price with way too much upside risk to volatility. For me, it's not worth the risk, but simultaneously, it's not ready to go and be entered into on the long side of the trade. So T, it is AT&T. Okay, I was right. All right. So AT&T does look a bit weak right now. So this big hump here after the earnings is it's not a great look. I'm thinking this one might be a short. Let me take a look at this channel. Yeah, I see this channel on it. The volume direction candles are kind of breaking to the downside here. We've had multiple touches outside the price cloud. This move was extreme, and we had a rejection here. Lots of crossovers to the downside. Lots of downside rejection. I'm shocked that it stayed up here for this long. This consolidation has been happening for a while, but it's not filling this gap. Like, you see this gap here, it's just not breaking it. It's not getting above it. So I'm thinking that AT&T is going to see some rejection. As a company, I kind of hate AT&T because, morally speaking, I think they're a really corrupt organization. They're one of those companies that is very much a monopoly and trying so hard to become more of a monopoly every day. They acquire anything that's small enough that they can grab, and anything that is extremely small, such that it's not worth it for them to acquire, but is getting enough traction that they could threaten them as a competitor in certain regions. They'll sue them arbitrarily with no reason to do so, and they'll just tie them up in courts until they bankrupt them because they know they can't fight them. They go into all these frivolous lawsuits against really small, like, regional internet service providers that just build up the infrastructure and start something up. Anytime that happens in AT&T territory, they beat the hell out of them in court until they can't afford to stay in business, and they ruin people's lives for trying to break into the ISP industry. The AT&T is a company that I would love to short on a moral basis alone. I don't care how big they are. I don't care how nice their financials look. If I find a short opportunity on this company, I would be thrilled to take it. But I am going to wait for a legitimate short opportunity. Okay. So, yeah, judging by the previous moves, this one I think is just about ready. Let me take a look at their earnings really quickly. Yeah, they beat all of their earnings for the last few years. This is the one disappointment that they had. They never really performed with the market during COVID. And now that we're getting this serious market downturn about to happen, I think that this is a good opportunity to short the hell out of them. On the daily, AT&T has formed a head and shoulders. We got a 1, a 2, a 3. hoping to see it break this level. And that would, if it broke $15, that would mean way more downside. I could see it going all the way to 12. Wow, okay. So I'll think about this one. But AT&T as a short play, I kind of like. The only problem is that they are very close to a bottom in their market, where the last time they were down here was in 2008. So it's been a long time since AT&T was trading down at these levels. For them to break this level would be quite difficult, I would imagine. I would love to see AT&T. I would love to see AT&T get punished for their freaking crooked ass business model. Okay. I'll catch up with you guys in chat. See, what is the bottom indicator of the chart called? This is called the volume direction candles. Volume direction candles by JD. This is a really nice indicator. It was actually that guy Astro Sam from YouTube that told me about this one. He was the one who found this for me, and he sent it to me. I love it. I love this indicator. It's an excellent indicator. It's purely measuring volume. It's purely measuring volume, and it takes into account the price momentum, and it scales the volume with price momentum. So whenever there's a big jump in price, the volume direction candles will push a little bit further. So it's putting a heavy emphasis on volume without only relying on volume. But in order for a volume candle to really show trend changes, it needs to come with big price action. But it's effectively a modified OBV. It's really nice. I love it. How about HLBZ? HLBZ. That one is, you know, I gotta say, like, the amount of volume in it is interesting to me, but it's still getting smacked right now. I'll take a look at it on our short data analysis. But I don't think that HLBZ showed up on our short interest and short exempt tickers list. I keep an eye on that pretty closely to look for any chance that the market is turning or favoring those kinds of stocks. Mainly because that's where those liquidity squeezes can happen, is something like this where it's near its 52-week low, and suddenly there's just this giant pop in volume. The volume direction candles are very much indicating that it's possible. Let me go take a look at the short exempt data. You guys can take a look at this with me if you like. I need to put it on the correct chart, though. Or the correct browser, rather. So this one is... The short exempts are pretty interesting. It's quite a bit, but we missed an opportunity down here. The short volume and short interest that the short exempt volume, excuse me, that really would have been ideal to hit this one at would have been right here, but we've already missed the 6-day window. So it would have required big buying volume to hit right at these levels when it hit 22 cents. Now we're trading below that, and we've already had a big flush. So, and we're past the 6-day window. So any market makers that would have been overextended in this area, they've already covered their positions by now. So we'll keep an eye on this one. I'll add it to my list and look around. If I see something happening with this one that points to a liquidity squeeze, I'll give it some more attention. But for right now, I'm just I'm thinking that it's not really quite a play just yet. But you feel free to send me some information in the Discord if you're in there. I check in with our Discord every single day. You guys can send me whatever DD you want. You can even send it to me. You actually don't even have to be a member of the Discord, technically. You can open up a support ticket, and you can send me information if you really want to get it to me. Because we have a support ticket system for that exact purpose. If somebody really needs to get in touch, if they're having trouble joining the Discord, anything like that, you guys can send us some information or write us a support ticket. STRY halted. Potentially news could be released. I'm not familiar with that ticker. Starry Group Holdings. Ooh, wow, that looks painful. The volume direction candles are interesting. That's very interesting. This one I think could be different. Give me 2 seconds to pull up the data. And I have to go soon, so this is going to be the last ticker that I analyze. Jay Morris, I'll get to your question, though. Because that only takes me a second to answer, but let me finish analyzing this really quickly. And then I'm going to have to go. Yeah, okay. Short exempts are pretty huge, but we've already missed the 6-day window. So this one's worth watching. We've gotten some signals that something's going on. And we have what appears to be an RSI divergence. So this could be RSI bullish divergence happening right here. This drop in price between lows, this can be bullish divergence because the price has created a new lower low, but the RSI is still pretty high compared to that. And the RSI is in deep oversold territory. This is in very deep oversold territory. Volume direction candles are very bullish on this. So I don't know what's going on with this organization. It looks like they've been selling off for a long time. I'll look at it and I'll give you some I'll give it some of my attention to see if there's any possibilities. I'm betting though that because this has been traded below $1 for a while now, for about a month, that let's see. This one's been trading below $1 since.
AT&T.
What's up, Dave?
Saying it could be AT&T, of course.
AT&T.
Yeah, but gotcha. they're one of the companies you.
Oh, I got you. Yeah. Right. October 20th. Around October 20th was when they went below the $1 threshold. So they're out of compliance, but they have at least another 4 months to get back into compliance before they have to even ask for an extension. And with an extension, they get another 180 days. So that would take them until the summer of 2023 before they would need to seek compliance, and fall of 2023 before they absolutely had to do a reverse split in order to save themselves. This one's interesting. Their income doesn't look good, though. They're losing a lot. $60 million every quarter in losses is not good. Their balance sheet shows they have some good assets, but they have a lot of debt. They have way more debt than they have assets to their name. Total current assets is $30 million in cash, and about $160 in illiquid assets. So they do have a lot in hard assets, not a lot of cash. They do need cash. Shareholder equity is in decline, bad decline, which is not good. Don't like that. Yeah, the total equity from shareholders is massively hurting. Their net debt being $201 million. That's a lot of bad debt. Okay. Short-term debt, they have $2 million. Long-term debt, I don't know what their financing terms are, but $230 million of debt is a bad sign. So I don't like the financials. It's not a good look for this company. They're hurting really bad. I need to spend some time analyzing them and figure out where their drain is at. But I'll at least read into them. They're a fixed wireless technology developer and internet service provider based out of Boston. Oh, now I'm really understanding the joke with AT&T. I didn't realize these guys were an ISP. That wouldn't be all that surprising. This is a company that would absolutely be a target. If they're getting targeted by AT&T, guess what? AT&T has infinite money, basically. They can beat the hell out of them if they want to. We really do need to restructure our entire internet services across the country. But the government will never do it. AT&T has way too many lobbyists just shoving fistfuls of money into every politician's pocket so that they don't do anything to mess with their business model. And you can quote me on that statement because I dare AT&T to prove it's not true. Yeah, I wouldn't do anything about it right now. You need to see an opportunity for this company to get some momentum going. But I'll keep an eye on this one. As a matter of fact, I'm going to add this to my watch list. I'm going to put it right there at the top because I want to keep an eye on this one. It's worth looking at. Well, pay attention. Okay. And then I'm going to go ahead and close the stream here. I'm over my time, so I really ought to be going. But I want to thank everybody for joining the stream. Jay Morris, you asked the question, what do I think about TikTok getting banned in 7 states? I think that that's phenomenal. I'm glad that people are taking their security seriously. It's serious. It's a serious problem that we've enabled this organization and the and TikTok as a company to continue to persist. And the way that its app is structured is wholly dangerous to all of its users. I've talked about it plenty of times, and I think that it's really a dangerous application. The fact that some states are banning it now is really good news, in my opinion, for any social media driven company that's looking to create short form content as a basis for its new revenue streams. BBIG being chiefly among them, and I feel like the executives of BBIG are seriously like pissing into the wind by not taking advantage of the opportunity. They're really, really screwing up by not doing something to make use of that. That's a tremendous opportunity lost if they do not capitalize on that. So I do have some serious problems with the BBIG executive staff for not doing something with that information. But I don't know. The silence from them is absolutely maddening. I don't know what we're going to do as far as BBIG as a company, but I do know that the executives, if they do not get those goddamn earnings out within the next month, then I'm going to start beating on the doors and start demanding for resignations and to put somebody else in the driver's seat, because right now nothing is happening. Something needs to happen. I don't care what their background is or their experience or if they're court appointed. I couldn't give 2 shits at this point. Get the damn earnings out. It needs to happen. Get the earnings out. Get the earnings out. Get the earnings out. If you're not going to report the earnings, I don't give a damn what else they have to say. Just absolutely no interest in any other opinions or any other statements or any other PR. I want the earnings reports. Get back into NASDAQ compliance. If you are not in NASDAQ compliance by the end of this year, then get the hell out of the way and let somebody else competent take over. That's how I feel about the whole TikTok ban, because this is a wasted opportunity right now. Yeah, I know it's just minor moves for the for government positions. It does only apply to government employees. Technically, it would be an infringement of freedom of speech to ban people from being able to download an application to their phone. But yeah, but yeah, I'm glad that the government is at least banning it on their devices. Thank you for that clarification, Tony. I probably should have mentioned that just to be very clear about what the news meant. But the fact that legislation is taking place in order to protect, at a federal level, users of Apple and Play Store apps from TikTok, and the fact I really do firmly feel that the app is malicious or can be used maliciously, that does need to be addressed. That's going to have to be it from me. I want to thank you guys so much for joining the stream. If you wouldn't mind, please leave a like on your way out the door. I'm going to play a quick ad as I end the stream. You don't have to watch it, but it helps out the channel, so appreciate it if you do stick around for it. And thank you so much for joining us, and I look forward to seeing you guys next time. Until then, have a hell of a time in the markets.